Good morning. This is a re-recording of a talk that I gave at Ashoka University recently. It was titled The Practical Utility of 7 Math Ideas. I'm doing this recording again while sitting in my balcony, so if you hear some sound of birds chirping in the background, that's because I'm outdoors, sitting in my balcony in an early morning at 7:30 a.m. Okay, I'm going to talk to you about the practical utility of some of the ideas that you have already studied in school and over here. The problem I'm trying to address is this. Modern education system is very good at teaching the important concepts that really matter. Many of these concepts are taught early, but no one teaches you how to use these powerful ideas later on in life. And over time, people forget about the power of these ideas. Today, I will remind you of some of those ideas that you have been taught and which you already know. But you may not know just how important these ideas are and how to routinely use them to become a better thinker and to get a competitive advantage over other people who either don't know about these ideas or more likely don't know how to use them routinely. All of these ideas, the ones that I'm going to talk about today, come from one discipline, mathematics. There are 7 of them. I use them in my professional work all the time, and I hope to show you with the help of some examples as to how you too can learn how to use these ideas routinely in your own professional work. Okay, let's dive in. The first idea that I'm going to talk to you about is called proof by contradiction. You know this. I mean, you studied this back in school. The idea of proof by contradiction is not new. You learned it in school when they taught you how to prove that the square root of 2 is an irrational number. And if you don't remember, here is the proof. Now, I'm not going to ask you to work through the elaborate proof. I want you to focus on the algorithm used in arriving at the proof. So how do you do this? You prove that the square root of 2 is an irrational number by first assuming it to be a rational number and then showing that if it was a rational number, it will result in some kind of an absurdity. So that must mean that the square root of 2 is an irrational number because the absurd things don't happen. Now you learned this in school and then you forgot about it until now. But the mental trick used in the proof is incredibly useful. Indeed, the smartest people I know of use it all the time. How do they do this? Let's imagine that you believe that there is something very wrong going on, but it so happens that almost nobody believes it. So what do? You use proof by contradiction. You start by assuming that nothing is wrong, and then show that if nothing is wrong, then it will lead to some kind of an absurdity. And because absurd things don't happen, therefore you have arrived at the proof using the same methodology used in proving that the square root of 2 is an irrational number. You prove that something is terribly wrong. We call this in Latin as reductio ad absurdum, which is a form of argument that attempts to disprove a statement by showing it inevitably leads to a ridiculous, absurd, or impractical conclusion. Let me explain this to you with 3 examples from the field of investing. The first example that I would take is Warren Buffett's words on the valuation of .com. Back in 2000, Buffett was asked by a Berkshire Hathaway shareholder to explain why he did not buy any internet stock. Recall that at the time, internet stocks were the rage. Buffett, however, had refused to participate in the speculative mania, and Berkshire Hathaway's stock price had hugely underperformed stocks of the internet companies, the .com companies. Some media reports even accused him of having lost it by not investing in the businesses of the future. Buffett used the tool of proof by contradiction to demonstrate the silliness of the market at the time. Here is what he said. When we buy a stock, we always think in terms of buying the whole enterprise because it enables us to think as businessmen rather than as stock speculators. So let us just take a company that has marvelous prospects that's paying you nothing right now where you buy it at a valuation of $500 billion. If you feel that 10% is the appropriate return and it pays you nothing this year but starts to pay you next year, it has to be able to pay you $55 billion each year in perpetuity. But if it is not going to pay you anything until the 3rd year, then it has to pay you $60.5 billion per year again in perpetuity just to justify the present price. I question sometimes whether people who are paying 500 billion implicitly for a business by paying some price for 100 shares of stock are really thinking of the mathematics that is implicit in what they are doing. For example, let's just assume that there is only going to be 1 year delay before the business starts paying out to you and you want to get a 10% return. If you paid 500 billion, then $55 billion in cash is the amount that's going to have to be paid to you year after year after year. To do that, it has to make perhaps 80 billion or close to it pre-tax. Look at the universe of the business in this world and see how many are earning 80 billion pre-tax or 70 billion dollars or 60 billion dollars or 50 or 40 or even 30 billion dollars. You won't find any. Unquote. Buffett used the same principle that I just described earlier, proof by contradiction. He started by assuming that, okay, let's assume that the value of this company, the fair value of this company, the correct value of this company is indeed $500 billion. And I'm a reasonable businessman and I need a 10% return. And if I need a 10% return, then it must give me $55 billion every year if I have to wait just 1 year. And then he goes on to arrive at the pre-tax earnings that are required to justify the current valuation of $500 billion. And then he shows that there aren't any companies out there aren't any businesses out there that earn anything close to $80 billion, which is the absurdity that comes out of the algorithm of proof by contradiction. And therefore, the $500 billion valuation must be wrong. It doesn't matter whether you're buying 100 shares or a billion shares. There is underlying mathematics implicit in the assumption, and that's what Buffett was referring to. Let me give you another example. This is from a fund manager called Ralph Wenger, who's now retired, but who used to manage a very successful fund many years ago. And I used to get his letters, and in one of his letters, he spoke about the disk drive industry. And he was speaking about the bubble in the disk drive industry. At the time when he wrote this letter, there was the bubble in the disk drive industry was raging, and in fact it had popped. And he was talking about the absurdity of the valuation of the disk drive companies. So this is what he said in his letter. Remember back in the early 80s when the hard disk drive for computers was invented? It was an important, crucial invention, and investors were eager to be part of the technology. More than 70 disk drive companies were formed and the stocks were sold to public. Each company had to get a 20% of the market share to survive. For some reason, they didn't all do it. Now this is funny, but I think you get the point here. And the point is that for a company to survive, it needed a 20% market share. And the reason for any company in the disk drive industry to survive, to have at least a 20% market share, was because of many reasons. One, it's a hugely capital intensive industry. Two, it's an industry with high rate of obsolescence. So the planted machinery or the equipment that you install to make 40 megabyte hard drives will get obsoleted when somebody comes up with new machinery which can make 80 or 100 megabyte hard drives, which is what was happening in 1980s. And therefore you have to keep investing more and more money to just to stay in the game. And in that kind of business model, you need scale, you need size to be able to have a profitable business model. And what Ralph Wenger figured was there are 70 companies out there, only about 5 are going to survive. So how do you know which one of those 70 will be the 5 companies? It's almost like picking a needle from a haystack. And he said it's speculative. There's no way anybody could predict with any degree of accuracy as to which of those 5 companies would survive. Which means 65 out of the 70 companies are going to go belly up, and that's exactly what happened. But instead of focusing on any specific company, he was focusing on the aggregate market valuation of the entire industry of those 70 companies. And he said that effectively that the investors who had bought stock in each of those companies were very bullish about their own personal favorite company. And instead of looking at any particular company, why don't we look at the aggregate market capitalization? And the aggregate market capitalization was so high, and the method that Ralph Wenger used was to demonstrate that the absurdity of their valuation was obvious from the fact that only about 5 out of the 70 companies would survive. In fact, less than 5 of them have survived. As you think about it, there are only a handful of disk drive manufacturers left in the world now. Let me come to the third example. This is of a guy called Harry Markopolos, who was the guy who tried to expose Bernie Madoff, the huge, gigantic Ponzi scheme, a few years ago. And Harry Markopolos gave an interview to 60 Minutes about what happened in that particular situation, and I'm going to play an extract from that now.
It's been 2.5 months since Bernard L. Madoff was picked up and charged with what's believed to be the largest financial fraud in history. Yet we still don't know much more about the alleged $50 billion scam than what Madoff initially told the FBI agents who arrested him. There are still no indictments as federal prosecutors continue to unravel the case and to try and figure out exactly what happened and who all was involved. But the proof that it happened can be found in the ruined lives of thousands of victims. The one person who knows the most and is willing to talk is Harry Markopolos, the man who figured out Madoff's scheme before anyone else. He sat down with us for his only television interview. Until a few months ago, Harry Markopolos was an obscure financial analyst and mildly eccentric fraud investigator from Boston, who most people would never notice on the street.
My modern Greek hero, how you doing?
But today he enjoys an almost heroic status, pursued by journalists and movie producers and honored by colleagues as the man who went to the Securities and Exchange Commission and blew the whistle on Bernie Madoff and his $50 billion fraud.
Thank you. Thank you. Please take your seats.
But he seems uncomfortable with all the attention and knows that he is no hero.
I stand before you, a $50 billion failure.
How many times did you send material to the SEC?
May 2000, October 2001, October, November, and December 2005, then again June 2007, and finally April 2008. So 5 separate SEC submissions.
And in spite of all of the things that you did, it still ended up in disaster.
There's nothing to be proud about in this case. I feel horrible about the result. It's been a total disaster for the victims.
It began a decade ago when Markopolos was working for a Boston investment firm. His boss told him that Bernard Madoff, a former chairman of the NASDAQ stock exchange, was running a huge unregistered hedge fund that was producing incredible returns. He wanted Harry to reverse engineer its trading strategy and revenue streams so that the firm could duplicate Madoff's results.
He had the patina of being a respected citizen, one of the most successful businessmen in New York, and certainly one of the most powerful men on Wall Street. You would never suspect him of fraud unless you knew the math.
So, I mean, you're like a math guy, right?
I've taken all the calculus courses from integral calculus to differential calculus, as well as linear algebra, and statistics, both normal and non-normal.
How long did it take you to figure out that there was something wrong?
It took me 5 minutes to know that it was a fraud. It took me another almost 4 hours of mathematical modeling to prove that it was a fraud.
What were the things that caught your attention?
It was the performance line. As we know, that markets go up and down, and his only went up. He had very few down months. Only 4% of the months were down months, and that would be equivalent to a baseball player in the major leagues batting .960 for a year. Clearly impossible. You would suspect cheating immediately.
Maybe he was just good.
No one's that good.
Harry said there were only 2 plausible explanations. Either Madoff was using insider information to rack up huge profits, or he was running a giant Ponzi scheme. So either way, he was doing something illegal.
Either way, I knew he was going to go to prison.
Okay, here is the cover page of the submission, one of the submissions that Markopolos sent to SEC. And this is a document that I shared with my class. I teach a course on forensic accounting and corporate governance. So my students in that course are required to read this paper. And it's a very fascinating paper because in this paper, Markopolos lists out about 28 red flags. He starts by, so let's go back, let's try to figure out how this guy was thinking. The reason why I cite this, of course, is because the whole world was giving money to to Bernie Madoff. It was a $50 billion fraud, and large, respected institutional investors were swindled by this guy. But there was one guy, Harry Markopolos, who did not fall for the charisma, who did not, believe the numbers, and he did his own forensic work. So we need to think about how was he thinking, what was going on in his mind, and that becomes obvious when you read this document. So um, Marco Polo's starts by a theory. He has two different theories. He has two alternate theories, and I'll come to the importance of alternate theories and keeping them in your head and entertaining them in a bit. But over here, he's saying basically that either Madoff was involved in a front-running operation, and therefore the returns were correct, but they were illegally obtained, or he was running a giant Ponzi scheme, which means he was taking money in from new investors and using that money to pay out good returns to the investors who wanted to exit from the scheme. And of course, that kind of a setup cannot last forever. That's mathematically impossible, and that's what happened ultimately. The Ponzi scheme sort of blew up when Madoff realized that he can't sustain this anymore, and he actually ended up confessing to the SEC. What's remarkable about this case is that it wasn't the submissions of the various submissions made by Marco Polos that got Bernie Madoff into trouble and into prison. It was, in fact, SEC conducted an investigation and found nothing wrong, which is like sort of incredible. And ultimately, Madoff went to prison not because of Harry Markopolos and his documents and the investigation that he had done, but because he himself turned himself over to the authorities. So, okay, now let's go back to the point that I was making here. The mathematical principle of proof by contradiction that Bernie Madoff was using. Now, that becomes obvious when you look at red flag number 4. Now, as you read through the red flag number 4, you will realize that this is nothing but an illustration of the same principle that you learned back in school. How do you prove that square root of 2 is an irrational number? You start by assuming that it is a rational number and then show that if that was true, then it will lead to an absurd outcome. This is what um, Marco Polos is doing in this particular document when he talks about red flag number 4. Essentially, he's saying is this, that you made all this money through trading in options, and we know how much is the volume of options. But to make the kind of money that you say you're making, Madoff, from these option trades, you would need to have a volume which is more than the total volume on the exchange, and that's not going to happen, and that's impossible. That's mathematically impossible. Therefore, you're lying. So we talked about 3 different examples of proof by contradiction, those provided by Warren Buffett, by Ralph Wenger, and Harry Markopolos. In each of those situations, we showed that these 3 guys assumed that the proposition was correct, and then they showed that if that was true, it will lead to an absurd outcome, and they ended up disproving a commonly held belief. But the general idea in these situations was that one looked for evidence to disprove a theory. How do you go about disproving theories? Well, one very good trick is to have many theories, and that's because, as Chartier mentioned, nothing is more dangerous than an idea when it's the only one you have. It turns out that most people can't hold multiple conflicting theories in their heads. The cognitive load is just too much. The human mind seeks easy, simple answers to even complex situations. And we call that first conclusion bias. The mind tends to jump to conclusions. It doesn't like to be confused. It wants to hold one theory and one theory only, which explains easily whatever somebody is trying to explain. In fact, a good thinker would, on the other hand, will always have the ability to hold many conflicting theories in his or her head simultaneously. You'll notice that from people you admire in science or in physics or in mathematics or in biology, in any of the hard sciences. I like this quote from Scott Fitzgerald, and he said that the test of a first-rate intelligence is the ability to hold 2 opposing thoughts in mind at the same time and still retain the ability to function. Indeed, this is exactly how good thinkers like Sherlock Holmes think. Um, and if you remember reading Sherlock Holmes, there was a passage in one of the stories in which Watson asks Holmes, "Do you have a theory?" And Holmes replies, "Yes, a tentative one." And just think about it. If you're a person trying to emulate somebody like Sherlock Holmes, you're trying to use his mental tricks. What will you do? There's a murder that has happened. You've been called to investigate. Now you got to have some theory. There has to be some motive. There has to be some suspects, and who's done that. So maybe it was the butler, or the wife, or the brother-in-law, or the neighbor, or the business partner. You don't know as of now, but you create plausible explanations. There are 4 or 5 plausible explanations. There are 4 or 5 theories. These are all tentative theories. Now when Sherlock Holmes tried to solve a case, he had no particular attachment to any particular theory. His attachment was always towards finding truth. So he went around looking for evidence, discarding theories one by one as they were falsified. And then he ultimately arrived at the truth. In one of the stories, he says, "How often have I said to you that when you have eliminated the impossible, whatever remains, however improbable, must be the truth?" This is the same point that I mentioned earlier when you're talking about proof by contradiction. You're falsifying theories. He's eliminating possible suspects one by one by falsifying his various theories in his head, and ultimately he's left with one theory, which he believes is the only explanation left to decide who did the murder. And I think falsification is a very powerful way to think. And the idea of falsification has been around for a long time. It was popularized first by the philosopher Karl Popper, and then by his student Nassim Taleb. And Nassim Taleb famously cites the example of a black swan. He says that if you try to go around proving the proposition that all swans are white, you cannot do that by looking at any number of swans. You may look at 100 swans and all of them are white. That doesn't prove that all swans are white. And you may look at 1,000 swans or a million swans, and even if each and every one of those swans turn out to be white, it still doesn't prove the proposition that all swans are white. However, if you cite a single black swan, that immediately destroys the proposition that all swans are white. This is a very powerful way of thinking because disconfirming evidence falsifies your theories. And I think it's important to recognize how important falsification is and how important it is to hold multiple hypotheses in your head and try to falsify them by looking at evidence dispassionately and objectively. Of course, this takes time, and until you have evidence one way or the other, you just have to hold those theories in your head without getting attached to any one of them. Um, I like to cite an example here from my own personal experience, and here I want to talk about a company called Eicher Motors, and they have a business division called Royal Enfield. And recently, this company's stock has fallen from about 32,000 rupees per share to about 22,000 rupees a share, down by about a third. And there have been many plausible explanations provided for that occurrence. One of them is that the company experienced a slowdown, and indeed the business volume of this company have fallen. But the question is, why has that happened, and if that decline is permanent or temporary? Now, there are various ways to think about it. Uh, One explanation provided by the company was that they had a strike and they couldn't produce enough. So it wasn't that the demand was tapering off, but because they couldn't produce enough motorcycles, and therefore they couldn't supply, and therefore the business volumes dropped. Well, that's one explanation. But if that explanation was true, then that would have meant that that decline should have been limited to only Royal Enfield, not to other companies. Well, that's not what turned out to be the case. If you look across in the last few months, there has been a decline, significant decline in business volumes of the entire two-wheeler industry, and that evidence effectively falsifies the theory that that Royal Enfield's decline was attributable to volume decline was attributable to the strike. So that one theory goes out of the window. You may have it originally in your head, which kind of goes out of the window. Um, then what are the other possible explanations? Well, One of the things that is interesting about what is happening inside this company is that they've launched a new motorcycle, 650 Twins, which have been getting excellent reviews. It's a attractively priced motorcycle, but the flagship product of the company, the 350cc motorcycle, is the one which makes the company most of its money. So what's happening? What may be happening? One plausible explanation is that there might be a lot of customers who are contemplating buying the 350, but they don't have. Now they're confused. They would want to buy the 650 instead because it's a better bike, it's a bigger bike, it's a better looking bike, it's got great reviews. But they don't have the money right now, and therefore they can't afford it right now, but they are deferring their purchases. So that deferment of their purchases for now is causing the volume decline to happen. I mean, it's a theory, we don't know the answer yet, but it's just a theory to keep in your head. What could be the other theories? Well, the other theory is that there is a new entrant in the market, Java, and they have recently entered the market. This is an old brand that used to exist back in 80s, and then it sort of stopped production, and they have come back through Mahindra and Mahindra, and they've launched a very attractively priced motorcycle. And that's again another plausible explanation that the arrival of a new entrant in the market, which is offering a product which is priced very attractively, unlike imported products which are priced much higher, the ones made by Triumph and Harley, which are very expensive and most people can't afford them. This product made by Java is actually priced very, very attractively, and therefore there is a possible explanation that people are switching from 350cc bullet motorcycle made by Royal Enfield to Java. Again, we don't know whether this theory is true or not, and we won't know for a while, but at least we have a theory to explain the decline in the business volumes of Royal Enfield. There's another theory, and this another theory is actually quite fascinating to me, because if I look around the world and look at the 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 nature of the automobile industry around the world, I find that in the developed world it is a cyclical industry. Business volumes tend to go up and they fall, and then they go up again. It's not a secular growth industry, unlike in India, where the two-wheeler industry has grown and grown and grown over the years. For the last 25 years, it's been growing consistently. Now, the question that I ask you is this: is this permanent? Will Indian two-wheeler industry not become cyclical? Why would it not become cyclical, just like it has in the other countries? And that's an interesting question. And at some point, there will be saturation of the market, and the growth rates will decline, and the industry would start resembling, in some sense, the demand patterns of what you see in developed world. Again, that's a theory. We don't know the answer yet, but it's a plausible explanation. So here is the thing. At this point of time, when I look at the data, it's impossible to tell with which one of those theories is playing out, except the first one, which has been falsified, which was the theory that the decline was attributable to the strike. So I don't know. I mean, there are 3 or 4 things going on right now, and maybe more will come. But if I had to think correctly, if I had to emulate Sherlock Holmes, I will entertain all of these 3 or 4 theories and not jump to buy the stock simply because the price has gone down, because I really don't know whether the growth rates have declined permanently or they have declined only temporarily. Another trick that's useful is called reductionism. Now, you have done reductionism back in school. If you recall, look at this equation. You are trying to reduce a relatively complex equation to a much more simpler form, as you see on the screen here. In some situations, we are reducing the problem to a simpler form, like in this case. In some other situations, we reduce the problem to a more fundamental discipline. And by fundamental discipline, I mean hard sciences, mathematics or physics or biology or chemistry. Indeed, this is what Harry Markopolos did. He reduced the problem of believability of Bernie Madoff's performance numbers, to mathematical absurdity. He showed that if Bernie Madoff was telling the truth about his performance numbers, then it would lead to a mathematical absurdity. The absurdity was in the domain of mathematics, which is a more fundamental discipline than the discipline of measuring the investment returns of a fund manager. And that's important, and that's something which Charlie Munger mentioned in one of his talks, and he said that you can never make any explanation that can be made in a more fundamental way than in any other way than the most fundamental way. Again, the second idea of inversion is something that you learned way back in school and maybe you've forgotten about all of it. Let me remind you. This is what you did in school. A question from probability. What is the probability of landing heads at least once in 10 coin flips? Now, there are two ways of doing this, if you recall, the long method or the short method. The long method is as follows. You start with the probability of exactly one heads, which is 0.5, and to that you add the probability of exactly two heads, and to that you add the probability of exactly three heads, and so on until you reach the probability of 10 heads, exactly 10 heads. You add up all those 10 different probability numbers, and you end up arriving at the probability of at least one head in 10 coin flips. The short method, on the other hand, is simply involves inversion. You invert the problem and you figure out the probability of no heads and deduct that from 1. 1 minus the probability of all 10 all 10 coin flips landing tails is what will give you the probability of at least one heads in 10 coin flips, and that number incidentally comes to 99.99%. So there's a 99.99% chance that you will land heads at least once in 10 coin flips. Now, you've done this in school, but uh, you have you may not recognize the importance of the idea of inversion, and that's something which a famous algebraist Carl Jacobi used to talk about. Invert, always invert. Another example from algebra that comes to mind is something that you see on the screen here. It's a form of an equation which looks a little complex, but what you're taught in school is to gradually start reducing it and start simplifying it and bring it all the way down to a more simpler form. And one way to do that is to shift terms from the right hand side to the left hand side, and that's exactly what we have done over here. And as we go down, we find that a simpler form of the equation is created, and we can work with that. So the idea of shifting stuff from one side to the other side is obviously the idea of inversion. Now, what are the applications of this idea? Many of them. So I'm giving you one example. If you remember, I just gave was the idea of earnings required to justify current valuation. I love this idea because it takes away the need to make predictions about future fundamentals of a business. Think about it like this. If I buy a bond today, let's say a AAA bond, and given that the interest rates are, let's say, about 10% pre-tax, then and if this was a perpetual bond which gave me 10% return year after year after year, I would pay 100 rupees for a bond that will pay me 10 rupees interest every year on a pre-tax basis. Now the earnings of this bond are not going to grow, nor are they going to shrink. So what does that mean? That means that the value of a non-growth perpetuity is 10 times earnings. 100 is the total value and 10 is the earnings that are coming out year after year after year. So the multiple that you would put on a on an earning stream, on a perpetual earning stream of 10 would be 10, which gives you a total valuation of 100. Now, why is this important? It's important because it's a very rough cut way of figuring out how much are you paying for growth. So instead of you take a business and instead of figuring out what the future fundamentals would be like, you just plug the current market value in this simple equation that I mentioned and figure out how much are you paying for growth. So if you're, let's say, paying 11 times earnings, then 1 time earnings is the growth component. If you're paying 12 times earnings, then 2 times earnings is the growth component. And if you are, let's say, paying less than 10 times earnings, then you're not really paying anything for growth. And that's amazing, because what that means is that if you could find businesses whose earnings are not going to shrink but will grow over time, but if you could buy them today at less than 10 times pre-tax earnings, then you're effectively getting paid to buy growth. and that's like a cheap lottery ticket. And indeed, isn't that what value investing is about? Picking up cheap lottery tickets. So instead of trying to make projections about future fundamentals, which is ridden with a lot of behavioral risks, and as I like to tell my students in my course at MDI, that the goal seek function that is embedded in Excel is really not needed, because the goal seek function is already embedded in you, the modeler. We build fancy models and with fancy projections, and mind plays tricks on us, and we come up with projections that will bring if we bring those future earnings that come out of those projections to present value, we're going to get the answer that we like. If you want to justify high valuation, we can play around with numbers any which way. We can change the interest rate a little bit, the discount rate, we can increase the margins, we can reduce the capital intensity, we can reduce the tax rate, and so on. There are like 30 or 40 variables out there. You play around with the numbers and you get what you want, and you bring those numbers to present value, and you get the valuation that you want. Now, obviously, that is riddled with a lot of risk. Instead of doing all that, why not simply take the current market value of the company as given, and from that derive the value of the non-growth perpetuity, assuming that the earnings are not going to shrink, but let's assume that they're going to remain the same and not going to change at all. We can figure out how much are we paying for the non-growth component and how much are we paying for the growth component. And once you know how much are you paying for the growth component, you can, it's a very useful piece of information, because then you can challenge that, you can compare that with your assumptions, you can figure out the risks to that hypothesis, whether the growth will occur or not occur. And once in a while you will come to the conclusion that that you're really paying too much for growth, and there is a lot of optimism embedded in the valuation, and it's a risky venture, and therefore don't do it. Or you might come to the conclusion that this is a growing company, but the market is not giving it the right multiple, and in fact the multiple is just too low. Multiple of earnings is just too low, and it implies that the earnings will not grow at all, or in fact they will shrink. But I have a different view altogether, and I think that the earnings of this company are going to grow, and therefore I'm going to buy, because I think that the growth of this company is intact, and I'm not really paying anything for growth, and it's like buying a cheap lottery ticket. Another example of this idea of inversion is asking the question, how to fail, and then just don't do things, don't do those things. I mean, instead of studying success, which is what people mostly do in business schools, why not study failure and figure out ways to avoid that failure? And that's a very elegant idea. It's been talked about Charlie Munger in many of his talks, and essentially, if you look at some of these wonderful ideas, you'll get the point that I'm making here. Here is the example of a great book written by Don Keogh, who used to run Coca-Cola at one point of time, and he's basically has a book which is called the 10 Commandments for Business Failure. He lists out those 10 things that you must do to destroy your business, and obviously, you're trying to not destroy your business. You're trying to succeed, and in order to succeed, all you have to do is to avoid doing those things. And Charlie has been saying this for a long time, as I just mentioned, and he said that in the context of a servicing industry. And I actually am invested in a company which is in the services business, and I shared this quote with the entrepreneur, with the founder, with the guy who runs that company, and he was sort of blown away. And he said that, well, this is something which I haven't tried, and I want to try this. It's a little counterintuitive, of course, because instead of trying to figure out what makes you successful, you're trying to figure out what irritates the customer, and just trying to chip away at those things and remove the various reasons for people to get alienated. Charlie has obviously has also said the words, which is, "All I want to know is where I'm going to die, so I never go there." It's a famous quote of Charlie Munger, and there's a marvelous book written by Peter Bevelin with the same title, which I highly recommend to all of you. Another example is that you got to avoid dumb behavior, and one way to avoid dumb behavior is to watch other people do dumb things and then simply avoid doing those things. And clearly, the benefit of learning from other people's mistakes is that it's less costly. The pain is less, or it's not there, and you're learning from the pain that is experienced by other people. There's a wonderful quote from Charlie Munger, and he said that you don't have to pee on an electric fence to learn not to do it. And if you really want to see how that happens, take a look. funny, isn't it? Yeah, I think it's really funny. These guys are peeing on electric fences, and I know somebody caught it. I think it's a security camera. Anyway, um, I think the metaphor is appropriate here because if you learn from the mistakes of others, it's hugely beneficial because the pain is not felt by you, but you derive all the right lessons. And it's just, you got to become a collector of folly. And every year, I teach a course on forensic accounting and corporate governance, and every year I get new cases of fraud or some shit that a company has got involved in and has caused a lot of problems. I mean, look at what Boeing is going through right now, or what Volkswagen did a couple of years ago by cheating on the diesel emissions. And you can learn so much by just, or what Theranos did recently. The whole company has imploded because of fraud. There are so many situations that come across year after year after year. Just by watching people do dumb things, you can learn to avoid doing those dumb things. Take a look at this. So I think it makes a lot of sense to watch other people do really dumb things and learn to avoid doing those things. And of course, if you look at the world of business, one dumb thing that entrepreneurs or business managers do is take on too much debt. And they do well for a while, and maybe for a goodly while, and then they end up blowing up. Uh, the reality is that debt makes a business model fragile. And it's fascinating to see how people miss this point. They don't realize that there is this capital structure where the guy who owns the equity is right at the end of the line. He's not going to eat anything. He's not going to get anything to eat until the others ahead of him have eaten whatever is their claim on the food that is available. Huge debt, as Buffett once said, we are told, will cause operating managers to focus their efforts as never before. Much as a dagger mounted on the steering wheel of a car could be expected to make its driver proceed with intensified care. Yeah, that's true. We know the upside. We know that people will be much more incented to do well, and there will be availability of cheap money, and you could do well if you have access to cheap money, if you're lucky. But you have to stay lucky, but you don't always stay lucky. The roads of business are riddled with potholes. A plan that requires dodging them all is a plan for disaster. So leverage is a dangerous thing. And if you want to look for disasters in business disasters, almost always you will find that one of the most common causes is excessive leverage. And there's a wonderful article that was published a few months ago in Business Today, and I really love this article. And it talks about many entrepreneurs who basically lost their companies. And I mean, the list goes on and on and on, but the point is that there's only one thing that was common in all of those companies, and that was excessive leverage. A few years ago, Credit Suisse published a document called House of Debt, and I love this document. I shared it with my class. This was in 2013, and it highlighted the troubles of some of the groups because of over leverage. You see them on the screen. These are 2013 or 12 numbers, and today, if you look at the market cap of these companies, it's not even like 4 or 5% of the market cap that existed at that point of time. And the common thing in each and every one of them is highly levered, fragile capital structures. And the things, the number of people who get into trouble because of excessive leverage keeps increasing year after year after year. And I I like to think of these guys as anti-models. I think you need role models to learn from, and that's something that business schools are very good at. They call people over, and these guys have accomplished a lot of things, and they come and give talks on how they became successful, and people start thinking that if they follow their methods, that they will become successful. Maybe there is an element of truth over there, but I think it's equally important to call people who failed, and not that they're going to come, and not that the business schools are going to invite them, but anyway, I think it's important to study failure. It's important to study people who have blown up, have done really dumb things in life, and try to learn from those mistakes, and basically say that, well, these guys have blown up. I don't want to be end up anything like that, and therefore I must avoid doing all the things that they did to end up where they have ended up. Um, I have this management checklist. When you think about investing in a business, there's a bucket which deals with the economics of the business, and there's the bucket that deals with the economics of the management, and there's a bucket that deals with the with valuation. So when it comes to the management bucket, there is a checklist which we call as the management checklist. And again, the way I think about it is that I have sort of inverted the checklist. Apart from asking how to make money by investing in businesses with good corporate governance practices, I also ask myself how to lose your shirt by investing in businesses with lousy governance, and then simply avoid those businesses. So I ask things that, what are the kind of things that you would expect to see if the governance was really bad, really terrible, and that should be avoided. So what are those things? There are like 4 or 5 of them. The first one on my checklist is a terrible track record in making expensive acquisitions. And we know a few people have done those things, and therefore I simply avoid those things. There are things like what Ratan Tata has done with Tata Steel, or what Kawar Mangalam Birla did with Novelis for Hindalco. Buying companies 4 or 5 times your size in an auction with borrowed money in foreign currency. I mean, it was compounding of one error on top of another error, on top of a third one and a fourth one. A second issue that I think that goes into my governance checklist is a terrible track record in diversifications. A third one is crazily expanding using borrowed money, and fourth one is creating a business castle using political clout. So I just don't like investing in businesses that prosper because they are close to a certain political party or a certain politician, or and so on, because I feel that that kind of business advantage is temporary. It's not going to last, and therefore I just simply avoid those things. Um, okay, so let's now talk about the third idea. Now, why did Munger say that? Why did he say that you need to use reductionism? You need to reduce problems to a discipline which is more fundamental to your own discipline. Well, I think the answer is that there is much more certainty in hard science than in social science. Social science typically deals with human beings, and human beings are unpredictable. That's not necessarily the case with situations that we encounter in physics. I mean, we do have uncertainty even in physics at the level of the particles. But I remember Richard Feynman once said that imagine how physics would be if electrons had feelings. Electrons don't have feelings, humans do, and therefore any system, anything that we try to understand which involves human beings is likely to be far more riddled with the risk of uncertainty as compared to situations which we encounter in hard physics. And the same logic applies in mathematics or chemistry or biology. I want to use an example to illustrate the point I'm making, which is the importance of reductionism. And here I want to cite the example of a company called Suzalon, which I used to talk about in my class back in 2006 and 2007. Now, this was a company which was one of the world's largest players in manufacturing wind turbines. And back in 2006-7, there was a huge asset price bubble in this industry. And I remember the aggregate market cap of the company at the time was about 45 to 46,000 crores. And I was kind of aghast at the total valuation of this company and that of other companies in this industry globally. And I did a sort of a thought experiment in the classroom, and I basically followed the example that I cited earlier about Buffett. when he tried to demonstrate the stupidity of the market valuation of a dot-com company at $500 billion. So here is what I did. I took the market cap of Suzalon, and I told the class that imagine that I want to earn a 10% return. Same logic that Buffett used in his method. Um, if you want to earn a 10% return, and how much money that the business needs to earn this year, and if you don't earn this money this year, then how much you need to earn the next year or the year after in order to compensate for the wait of time. Um, and then I moved up from in the profit and loss account, moved up from profit after taxes to profit before taxes, and then moved up further all the way up to revenues. Recall that uh, uh, in the case of Buffett's example, the he stopped at pre-tax earnings. He didn't move up further all the way up to revenues. But I, in my class, when I was talking about Suzalon, wanted to demonstrate the power of reductionism. So I moved all the way up to revenues. I said, well, this is what they earn after taxes. This is what they need to earn to justify this valuation. And we know the margins, we know the tax rates, we know how much is the pre-tax earnings that are required to justify the current valuation, and now and in the next few years, and then move up further to figure out what the revenues would be, because the margins of the business were known. And once you arrive at revenues, you know that, and then you're trying to figure out what the quantitative volume that the business needs to deliver to justify their valuation. So once we know the pricing, so once we know the total revenues that are required, we know the pricing. From pricing, we can derive the total unit volume, how many megawatts of capacity that the company needs to deliver in year 10, let us say, to give us the revenues that would be required to produce the earnings that would be required to justify the valuation today. And so this process of reductionism leads you all the way to a number which then can be examined critically. So once I had that number, I wanted to show that it's mathematically impossible to have to deliver on that number. Now, how did I do that? I use elementary physics. So here is the methodology that I use. I said, well, if this is the aggregate market value of the industry and this is the amount of megawatts that they need to deliver in year 10 to justify the aggregate market capitalization of this industry, then to do that, they would need to install so many wind turbines. But here's the thing about the wind energy business. There is only a limited amount of space in the world that can take wind energy, that can have installations of wind turbines, and and those places happen to be the ones which are near a lot of wind. And of course, you have a lot of wind in the North Pole and the South Pole, but people don't live there. So you're constrained by the need to only limit yourself to those areas which are near where human populations live, and there is a lot of wind. That was the first point. The second point was that there will be cherry picking. The first sites, the most important sites would already be taken up. So every time you look for a site to put your wind turbine, it will be inferior to a previous site, and therefore the efficiency of a turbine that is installed many years down the road should be lower than the efficiency of the turbine installed earlier, simply because of the locational advantage of the turbine that was installed earlier. That was the second point. And therefore, by using this method, I wanted to demonstrate that there isn't enough place on this planet Earth to have the number of wind turbines that are required to produce the amount of electricity that is required to be purchased by customers to deliver the revenues for the wind turbine industry, which will create the earnings that are necessary to deliver to justify the current market valuation. And therefore, the whole thing was a bubble. And of course, I did that in the classroom, and the market cap of this company was about 45,000 crores, and I was short the stock, by the way, and then this market value went all the way up to 64,000 crores, and I lost money on that trade, and proving, um, I think John Maynard Keynes right when he said that the market can remain irrational longer than you can remain solvent. That's a different story altogether, however, and basically one of the reasons why I don't short stocks anymore, even though I have deep conviction that I'm looking at a bubble valuation. But that's besides the point. The point that I'm trying to make here is that reductionism works. Today, the market value of Suzlon is not even 3 or 4% of the aggregate market valuation that existed in the peak in early 2008. So I think it's terribly important to use reductionism in the method that I followed, in the method that I described to demonstrate that there is a bubble valuation. And in this particular case, I went from uh, market value of a company all the way to the amount of electricity that is required to be generated in year 10 to justify that valuation. And the second number, the amount of electricity that is required to be generated in year 10, was a number that came from physics. I could demonstrate that there is no way that they could achieve that because there isn't enough space on this planet to do that. And that was interesting to students because they could clearly see, and most of my students happen to be engineers, and they could clearly see the logic of what I was saying, that if there is not enough space to deliver the electricity, then how the hell you could justify the valuation of Suzlon or that of other companies in that industry at that time. And if I feel that anytime you're looking at a crazy bubble valuation, it is always a good idea to move from the current market value to required returns to post-tax earnings required in a few years from now to pre-tax earnings all the way to revenues, and then split the revenues into pricing and unit volume, and then look at the unit volume dispassionately and objectively. Okay, so now let's talk about idea number 2. The third idea is called the law of large numbers, and it comes from the theory of probability, which you studied back in school. In probability theory, the law of large numbers is a theorem that describes the result of performing the same experiment a large number of times. According to this law, the average of the results obtained from a large number of trials should be close to the expected value and will tend to become closer as more trials are performed. Now this becomes clear when you look at this particular chart, which is a depiction of what happens when you roll a die for a large number of times. As an illustration of the law of large numbers using a particular run of rolls of a single die. As the number of rolls in this run increases, the average of the values of all results approaches 3.5. While different runs would allow different shape over a small number of throws at the left, over a large number of rolls to the right, they would be extremely similar. I mean, another way to think about this is to think about what happens when you flip a coin. If you flip a coin 10 times, it's not impossible or unlikely that you may get 8 heads and 2 tails. But if you flip them a million times, over the as you increase the number of flips, the number of heads and the number of tails will equalize. They will tend to become 500,000 each. Now this is also related to the idea of mean reversion, which of course is a very powerful idea, not just in life but also in understanding financial markets and businesses. Let's talk about an example instead from the domain of casino. And I like to show this example to my class about how you can learn value investing by going to a casino.
Who could resist? Anywhere else in the country, I was a bookie, a gambler, always looking over my shoulder, hassled by cops day and night. But here, I'm Mr. Rothstein. I'm not only legitimate, but running a casino. And that's like selling people dreams for cash. I hired an old casino pal, Billy Sherbert, as my manager, and I went to work. For guys like me, Las Vegas washes away your sins. It's like a morality car wash. It does for us what Lourdes does for humpbacks and cripples. And along with making us legit comes cash. Tons of it. I mean, what do you think we're doing out here in the middle of the desert? It's all this money. This is the end result of all the bright lights and the comp trips, of all the champagne and free hotel suites, and all the broads and all the booze. It's all been arranged just for us to get your money. That's the truth about Las Vegas. We're the only winners. The players don't stand a chance. And their cash flows from the tables to our boxes, through the cage, and into the most sacred room in the casino. The place where they add up all the money, the holy of holies, the count room.
So casino is actually a very safe place. Of course, not for the gamblers, but for the people who own the casino. Why is that? One, odds are in favor of the casino. Every bet that the gambler makes has a probability of as a negative expected value. The odds are in favor of the casino winning. Second, there is a cap on maximum bet size. So even if the odds are in favor of the casino, that doesn't mean that some gamblers won't win. In fact, some gamblers will almost always win, which is why it attracts them to go to the casino in the first place. What happens is in the law of large numbers, when it plays out, as the number of the amount of playing increases, the casino ends up almost always winning. But there is always a possibility that a high roller comes in and he puts a large amount of money on a single number on a roulette, for example, and the ball lands on that number. This could wipe out the casino if they have to pay a huge multiple of that number, 35, 36 times that number to the customer. It could wipe out the casino, which is why the casinos always have a cap on maximum bet size. And the third, of course, is the point I was making earlier, which is the law of large numbers. You want lots of play. If you're a casino operator, you don't want one or two customers to come in, you want lots of customers, because that shifts the odds, that changes the overall probability of coming out ahead, reaches almost 100%. Now here is a very interesting example that I want to cite. It was first mentioned, I first learned about it in security analysis by Ben Graham. And he talks about what happens from the perspective of the gamblers when they try to spread the risk by putting the money on various numbers. Now, the example I'm going to cite is that of the American roulette, which has 38 slot numbers, 1 to 36, 0 and 00. The payout ratio is 35 to 1. If you bet $1 on your lucky, let's call your lucky number 8, and the ball lands on number 8, you will win $35. Otherwise, you lose $1. If you gamble 1,000 rupees, then the probability of winning is only 1 by 38, which is 2.63%, and the probability of losing is 97.37%. Now let's calculate the expected value. A 2.63% probability of winning 35,000 as compared to a 97.37% probability of losing $1,000 ends up giving you a negative value of 53.20. This is this is what we mean when we say the odds are in favor of the casino. Now, imagine that there is a gambler and he thinks that he will spread the risk. He's got $1,000 and he can put money spread it equally on all numbers. And if he did that, of course, he's certain to win because the ball is going to land on one of those 38 numbers. So he spreads the risk. He has a system of diversifying, and he evenly spreads his $1,000 on each of the 38 numbers, which means he is putting 26 rupees and 32 paisa on each number. Then what will happen is that he will have a 100% chance of winning 35 times the money on one number, and he will lose the money on all the numbers. And if you do the math, you find out he ends up losing 78 rupees and 80 paisa. There's a big lesson here if you think about it, and it has vast practical consequences about how do you construct portfolios. The big lesson here is that diversification did not help the investor. In fact, the point that the gambler diversified his risk guaranteed that he will lose 78 rupees and 80 paisa. Going back to the previous example, if he had put his money on one number, at least there was a small chance, a 2.63% chance that he could win $35,000. But when he spreads the risk, he's certain to lose money. There is no way he can come out ahead if he spreads the risk. Now, what is the big lesson here? The big lesson here is when the margin of safety is negative, diversification is going to hurt you. You need positive margin of safety for diversification to help you. And of course, the same lessons work in investing. You want odds to be in your favor. You want to put a cap on the maximum bet size because things can happen, shit happens, something goes wrong. You put all your money in one or two businesses, and something terrible happens to those businesses, and you're wiped out. And number three, you want diversification. Now, clearly, the decision about how much to diversify is a function, in part at least, to the to the to the odds that are in favor. If the odds are not in favor, then we already know that you have a negative margin of safety, and diversification is going to hurt you. If odds are mildly in your favor, as happens in the casino, look at the problem from the point of view of the casino. Casino insists on wide diversification. They want lots of play. When they see lots of play, they find that some customers are winning money, but in the end of the day, they end up coming out ahead. So here is the thing: if the margin of safety is mildly positive, which happens in many casino situations, then you want lots of diversification. But what if the margin of safety is hugely positive? If odds of winning are hugely in your favor, then what happens? Then logically you should have a more focused portfolio. You should have less diversification. So the need for diversification is inversely proportional to the amount of the quantity of odds that are in your favor, and that's a very important principle to keep in mind when you sort of think about investing and building out portfolios. The law of large numbers is therefore very useful in helping us thinking about how to invest and what kind of strategies to invest into. If, for example, you're investing in a venture fund, then you know that most of the bets will fail. Some of them will succeed, and maybe one or two of them will make so much money that they would wash away all the sins. They will make back all the losses in the ones that didn't make any money for you, and therefore the margin of safety is low, and therefore you need a lot of diversification. Now, if you compare that with investing in, let's say, high quality moated businesses, it's very low chance that you're going to lose money on those situations, provided if you can hold on to them for the long term, and provided you haven't really overpaid for them, and provided, of course, that the moat stays intact. In those situations, a focused portfolio is much more appropriate than a well diversified portfolio. The sixth idea is that of small probabilities but large consequences. And if you recall, again, you studied this in school, and when you studied probability in school, you were taught through examples of urns and balls and dice, and there were only discussions on probability and chance, but never about consequences. And this was, I think, a deeply flawed way of teaching probability in school. I think one of the most important aspects of thinking probabilistically is to not only think about probabilities but also to think about consequences. Let me explain this and a lot of smart people don't do this, by the way. Some really smart people out there make that mistake. And so here is an example. There are two guys, Nobel laureates, and these are people who actually wrote the Black-Scholes option pricing formula. They used to run a fund called the Long-Term Capital Management, and this fund basically blew up. And the reason why they blew up is because they were doing a certain kind of a trade that was very risky. If there are a very small chance of blowing them up, and that's exactly what happened essentially. They were arbitraging between the price of 30-year treasury bonds with those of 29-year and 3/4 of a year treasury bonds, and the spreads between these two, the prices of these two bonds are very small because they are virtually identical securities with zero credit risk, and they were buying the one which was relatively cheap and shorting the one that was relatively expensive. And of course, in a situation like that, when the spreads are so narrow, the only way you can make a reasonable return or a good return on your capital is by leveraging up, and that's what they did. If you look at this slide, you see that they had $4.7 billion of equity, and on top of that, they had $125 billion of debt, and so they were like hugely leveraged, and they thought that, and they had done a lot of back testing, and they had gone back in history and looked at billions of trades, and found that never has there been a situation where the spread went beyond a certain number. So they were following the idea of mean reversion as if it was some kind of a law of physics. They didn't realize that they were dealing with humans, and human emotions are unpredictable, and markets can stay irrational longer than you can stay solvent, to borrow the famous quote from John Maynard Keynes. And that's exactly what happened. The spread, instead of narrowing, and which would have yielded a small profit for them, it widened and it stayed wide, and they had margin calls and they basically blew up. And many years later, Warren Buffett gave a talk on this situation, and he said that to make money, they didn't have and didn't need. These are all rich guys. They risk what they did have and did need. And he says that doesn't make any sense. It's completely foolish. If you risk something that is important to you for something that is unimportant to you, it just doesn't make any sense. And he gives an example. He says that if I had a gun, if you give me a gun with 1,000 chambers or 1,000,000 chambers in it, and there's a bullet in one chamber, and you said put it up to your temple, and how much do you want to be paid to pull it once? I'm not going to pull it. You can name any sum you want, but it doesn't do anything for me on the upside, and I think the downside is fairly clear. But the functional equivalent of what Buffett is describing, people pulling guns on their heads, even though the probability of them getting killed is very small, it's a very small chance, but the consequences are so devastating that they don't realize, they don't think in terms of consequences, they only think in terms of probabilities. It's almost like jumping out of planes that will open up 99% of the time. If you keep doing it, then the probability of your getting killed is 1. And that's again a very important point to remember. When you studied probability, you looked at if the idea that if you increase the number of trials, remember the law of large numbers. If you increase the number of trials, then small probabilities become large probabilities. That the probability of something bad happening to you may be very small if you do it infrequently, but if you keep doing it, the probability converges to 1. And it's not just about money, it's also about something that is terribly important to you. For example, your reputation. And you see that all over and over again that people have spent a lifetime building a reputation, and they do something really dumb that destroys it, and once you lose that, you're never going to get it back. Another powerful example that explains or illustrates compound interest is compound interest inside a business. Now, you all know how money can compound when you put it in a bank account, or if you put it in any interest bearing security. How the power of compound interest plays out in the long run. But I want you to really think about also how money can compound inside a business. The compound interest exists not just in fixed income securities that you can park in a bank or in a bond, but also exists inside a business itself. And that basically is the return on capital. If you really think about it, the return on capital invested in a business is no different from the compound interest formula. And if you can find a business that can compound its money internally at a rate of return that is lucrative, then wealth is going to be created. And of course, the reason why a business could do that over a long period of time is because it has longevity, it has the ability to compound its capital internally at a high rate of return without getting worried about competition. So there has to be high entry barriers, and um, and the and good prospects for growth, for internal compounding to take place. And I'm not going to get into details about that because that's a topic by itself, something that I teach in my courses in my MBA programs. But the essential idea is that compound interest inside a business is as powerful as compound interest that you see in fixed income securities or in bank accounts. And Buffett made it very clear when he basically said, if you don't find a way to make money while you sleep, you will work until you die. And he was basically saying that when you start young and you have jobs and you have income, and you should try to save money and not give into delayed gratification, and put that money to work and put it in good businesses which will compound your money even while you're sleeping, and in the long run this will pay off in a very big way. And it doesn't get more fundamental than that, isn't it? idea number 5. This idea is called the multiplication rule, and again this is something that you studied in school while studying probability. And the idea is that if two events are independent in the sense that the outcome of one event has no influence on the outcome of the other, then the probability that they will both occur is computed by multiplying the probabilities of the individual events. So you have to figure out what is the probability of throwing 3 and 5 on two different rolls of dice. So obviously the probability of getting a 3 is 1 on 6. The probability of getting a 5 is also 1 on 6. But if you want to calculate the probability of 3 followed by 5, it's 1 by 6 multiplied by 1 by 6, which is 1 by 36. Now this is something that you studied back in school and then forgot about how to apply it routinely in your profession, in the way you think about things, and how you should use it routinely in your professional work when you get into a profession. So here is an example from my profession and how we think about these things. So let's imagine that there is a 90% chance that a bad thing won't happen. That means there's only a 10% chance that something bad, something that you don't want to happen, will happen. And let's say there are 5 such independent things. Then what is the chance that at least one of them happen? Now notice that we're going to use the power of inversion, the trick of inversion that I talked about earlier, along with the multiplication rule here. So there's a 90% chance that a bad thing won't happen, but you don't want bad things to happen 5 times in a row. So the probability of that is 0.9 to the power of 5, and the chance that you will see at least one of those things, bad things happening, is 1 minus 0.9 to the power of 5, which gives you a 41% chance. Now this is important to understand because here we are looking at situations where there is a weak link. There is some weakness in the business model, for example, or in management quality. That's something that really worries you, but you think it's a low probability event. But you don't want that to happen. And I think one good way to explain this is through the example of a company called Mid-American Energy, which is owned by Berkshire Hathaway, Warren Buffett's company. And he talked about it in one of his letters, using the importance of the multiplication rule and how he thinks about it routinely in the way he thinks about the world of business and investing. Here is what he wrote. Last year, Mid-American wrote of a major investment in a zinc recovery project that was initiated in 1998 and became operational in 2002. Large quantities of zinc are present in the brine produced by our Californian geothermal operations, and we believe that we could profitably extract the metal. For many months, it appeared that the commercially viable recoveries were imminent, but in mining, just as in oil exploration, prospects have a way of teasing their developers, and every time one problem was solved, another popped up. In September, we threw in the towel. Our failure here illustrates the importance of a guideline. Stay with simple propositions that we usually apply in investments as well as in business. If only one variable is key to a decision and the variable has a 90% chance of going your way, the chance for a successful outcome is obviously 90%. But if 10 independent variables need to break favorably for a successful result, then each has a 90% probability of success, then the likelihood of having a winner is only 35%. In our zinc venture, we solved most of the problems, but one proved intractable, and that one was too many. Since the chain is no stronger than its weakest link, it makes sense to look for, if you'll excuse an oxymoron, monolinked chains. And this is very, very powerful, I think, because in my professional work, I look at this a lot. I look at business models and I look at weakness in the business models and independent factors that contribute towards that weakness or fragility in a business model. And even though the probability of weakness manifesting itself might be low, you don't have to think about individual probabilities because there are 4 or 5 things that can bring down a company, for example, and you don't want any of them to happen. So you have to think about, and the probability of any one of them happening may be low, but you're really worried about probability of at least one of those things happening, which is equal to the probability of 1 minus, which is equal to 1 minus the probability of none of those things happening. And when you do the math, even back of the envelope sort of calculation, you come to the conclusion that it's actually quite a high chance. It's much higher than what people think when they don't think in terms of multiplication rule. So using multiplication rule has helped me stay away from businesses that had inherent fragility that was not manifesting, and I saved the money that I could have lost if I had not thought through carefully about the inherent risk in that situation. Another example about compound interest is to do with frugality, and it's something which is, I think, very important for people like you who are young and who are starting out in their lives, and to understand how important frugality is, at least in the early part of your life, because you really want to build a nest egg, and that requires the need to delay gratification. And if you look at people like Ben Franklin, who wrote Poor Richard's Almanac or The Way to Wealth, they talked about the importance of frugality as well. And it's very important to know about this early in your life, because if you start early and if you don't give into instant gratification, if you don't, for example, even have a credit card. So I tell my students not to carry credit cards and carry only cash in their wallets, because the very idea of having a credit card means that you are prone to buying things that you don't need, and just by refusing to carry a credit card, you will be able to delay gratification much more easily. Uh, as Ben Franklin said, it's easier to suppress the first desire than to satisfy all that follow it. Buffett once said that life is like a snowball. All you need is a wet snow and a really long hill. So if you start early, even with a small sum of money, and if you delay gratification and you save money and you invest that money wisely, then over the long term, it's going to become a very large sum of money. And I'm now 53 years old, and I just wanted to give you a personal example that if you do this long enough, then you start getting sort of a kick out of frugality. At least in some parts of your life, in my life, even now, I get a kick out of frugality by, for example, not buying any shampoos. I travel a lot and I stay in hotels and I pick up shampoo. This one is from Sofitel, and I don't buy conditioners. And this one is from the Oberoi Hotel, and I don't buy soap. This one is from the Crown Plaza. And every time I travel, I pick up the toiletries that are kept in the bathroom. And if I'm traveling with friends, and if they don't carry theirs, I will ask them to give them to me. And over a period of time, I find that I have all these items collected, and I don't see any reason why I need to spend money on buying shampoo or conditioners or soap. I would rather save the money and put it to work, and in the long run it will make a difference. But there is a psychic kick out of it that I get, that I feel good that I'm not really spending any money on something as frivolous as shampoos or conditioner, which other people think of as necessities. And this is the key point that Ben Franklin was making when he said that you think that these are necessities, but they're really not, and you should try to avoid spending money on things that are frivolous, and in the long run, it will make a huge difference. Another example that illustrates the idea of the power of large numbers or mean reversion is investing in cyclicals. And here the general idea is that there will be recessions and there will be booms, and there will be again a recession and there will be a boom. And this cyclical tendency will last for a long, long time. And there are many industries which follow this pattern: steel, for example, shipping industry, for example. And here, basically, the idea is that good times won't last, and nor would bad times. And you can use this model to help you think through as to how to go about investing in cyclical industries. And Ben Graham, when he wrote his book, Security Analysis, he started it by quoting from Horace, and he said that many shall be restored that are now fallen, and many shall fall that are now in honor. And essentially, the idea here he was trying to illustrate was that you should look at out of favor industries and out of favor companies, and because they have been derated and sometimes unfairly so. And if you look at those situations, then the risk of losing money is low, and the upside is actually quite good if you follow some of the methods that he describes in his book. Similarly, the idea of stock returns and stock prices are the relationship between these two factors is quite interesting. Um, if you think about it, in the long term, stock prices of most countries, the indexes, in the indices, they tend to go up, and but that's not the case with stock returns. You may have years of positive stock returns followed by years of negative stock returns, and here the general idea is that um, the stock market is trying to reflect corporate the change in corporate earnings. And if corporate earnings are growing and they continue to grow and there is significant earnings retention, the book values will continue to go up. And if that happens, stock prices would tend to reflect that over the long term. But stock returns, on the other hand, are reflecting the underlying returns on investment in the businesses that are inside the index. Uh, so, for example, if corporate return on equity is 20%, then there will be years in which the stock market returns will be less than 20%, and there will be years in which stock market returns will be much more than 20%. But by and large, in the long run, stock returns would tend to converge to the underlying corporate return on equity. And this is the point that Warren Buffett was making when he said that bull markets and bear markets can obscure mathematical laws, but they cannot repeal them. Notice the reference to a mathematical law, a law from a hard science, and he's basically saying that underlying mathematics of the compounding of corporate book value is what would determine long-term stock price returns, and that's exactly what um, Ben Graham meant when he said that in the short run the market is a voting machine, but in the long run it's a weighing machine. In the short term, the markets can do crazy things because their behavior is determined by people who are often quite irrational on either side, on the buy side or on the sell side. But in the long run, it's the underlying fundamentals that will determine the stock price of a given business. And here again, the point is that the fundamentals are mean reverting, or rather, I should say that the stock prices are mean reverting, and stock returns are mean reverting, and in the long run, the returns of the business would reflect the fundamentals of the business. If the fundamentals of the business are excellent, you are going to, in the long run, see excellent returns from the business, and if they are terrible, you're going to see terrible returns. Another example that I like to cite when I think about mean reversion or the law of large numbers is what happens when you have very low entry barriers and high profitability. And this is obviously a trap for many investors because they get seduced into thinking that this would last for a long time, but it wouldn't. In this case, the profitability would be mean reverting. High profit margins are like a honeypot, to borrow the analogy used by Philip Fisher. Um, and it's like a jar of open jar of honey owned by the prospering company. The honey would inevitably attract swarm of hungry insects bent on devouring it. And this is something that we should regard as a fundamental law of business. During shortages, even commodity businesses become ridiculously profitable, and the temptation to grow like crazy is just too much. And it is not necessary for all players in the industry to fall for the temptation to expand capacity so much that in a matter of few years the shortage will turn into glut. Only one player doing it is sufficient. And this is the point that Philip Fisher is making, that when there is temporary shortage, there is the profit margins of a given business are very high, and but they mean reverting. They will go, and the reason why they will go, they will not stay, they will not sustain, is because there will be more competitors entering into the market because the entry barriers are low. Uh, um, let's now move towards the fourth idea, which is again one of the most powerful ideas that comes from mathematics. It's called compound interest, and this is something which obviously you studied back in school. And I'm not going to get into what happens when you compound money at 18% versus 15%, and over the long term the outcomes are going to be vastly different. You already know that. Um, but here I want to cite the importance of the formula that you see on the screen: amount equals principal plus 1, principal into 1 plus r to the power of n, as to what are the underlying trade-offs that are inherent in this particular equation. And here I want to cite this with the help of an example called delayed gratification. Notice that I have circled two terms over there, and the underlying objective is to maximize A, And you can do that by focusing either on R or on N. And R means the returns on the investment, the near-term profits that you can make, and N means the period over which you can make that. And there are huge trade-offs between R and N. And if you're short-term oriented and if you focus on near-term profits, or if you're very greedy, or you're giving into instant gratification, you're thinking about how much you can do right now, you'll be focusing on R. But if you are focusing on maximizing A through longevity, you'll be focusing on maximizing N. And this is a point that was discussed at great length in an experiment many years ago, many decades ago, called the marshmallow test. And here is a brief video on that. And I think there's a lot of wisdom in the findings of the marshmallow test, and people who are able to delay gratification end up doing very well in the long run, and people who give into the temptations of instant gratification end up losing out in the long term. An example would be a company called Valiant Pharmaceuticals, and this company is going through a terrible time right now, but it used to be a hot stock and a hot business a few years ago. And and there are many things that are worthy of learning from this particular company, but I'm going to only focus on one aspect of it, and that's the aspect which is described in this particular slide. And it shows that this company, which is a pharmaceutical company, used to buy brands of other pharmaceutical companies before they went off patent, and it would jack up the prices. Some of these drugs were life-saving drugs, and as you can see that one drug on top, its price has been increased by 2200 something percent. And the idea was that customers are price insensitive in pharmaceutical industry, and you have pricing power, and if you increase the prices they have no choice, but they'll have to continue to buy your medicines, and therefore your profitability will go up. And therefore the focus again here in this situation was on the R and not the N or the A. R means the near-term returns, the near-term profits. And what they didn't realize, of course, was that society will come back and hit you because there was a regulatory pushback and there were investigations on the company, and there are many other things that went wrong with the company. But the point is that the company exercised greed, and they displayed their greed, and they ended up essentially killing the goose that laid the golden eggs. And that's actually a very interesting story. You read that back in school, killing the farmer that killed the goose that laid the golden eggs. Well, that story is exactly what we are talking about right now. On the other hand, there are people who think very differently. And, at the other end of the spectrum, there are people who think about longevity, and one of the guys who would come in that category is clearly Jeff Bezos, and he is really focused on increasing the longevity of the business. He thinks truly long term. He thinks about how to create solid entry barriers by investing for the business, and he's done that. He's the world's richest man now, and clearly studying Jeff Bezos is really reminds you of the marshmallow test. It does remind me of the marshmallow test. I sometimes think that if he was in the marshmallow test when he was a kid, he would have certainly said no to uh, to 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 having two marshmallows right now. He would have delayed gratification, and and would have come out far ahead in life, which he did actually. So going back to the point I was making, Valiant is like the farmer who killed the goose that laid the golden eggs, and Amazon has created value while Valiant has destroyed. The final idea that I want to talk to you about today is Bayesian thinking or Bayes rule. And again, you studied this back in school. The idea comes from again mathematics and probability theory. And I remember when I was in school, they taught me what at that time we used to call it conditional probability, and which basically means the probability of an event given that another event has occurred. And my head used to spin when I used to look at the way they were teaching that subject. And this is a typical example taken from a CBSE textbook. And when it was over, I was sort of glad it was over. A couple of decades later, I discovered Charlie Munger and the power of multidisciplinary thinking. And I remember musing over his words. Worldly wisdom is quite academic when you get right down to it. And then I came across Danny Kahneman's book, Thinking Fast and Slow. And in that book, he makes the idea of Bayesian reasoning very simple to understand. And he converts the whole problem into an equation, which he calls as posterior odds, which equals prior odds into likelihood ratio. Now, think of prior odds as something that you already believe, it's an existing belief. And then likelihood ratio is something that represents new information. And this new information will either intensify your existing belief or will dilute it or will leave it unchanged. So the likelihood ratio, when you combine it with prior odds, will give you posterior odds. And the general idea is that you're always trying to think about how to respond to new information. And in my profession, this is exactly what we do all the time. There are all kinds of new information coming in, quarterly results coming in, important announcements coming in, industry dynamics changing, acquisitions happening. There are all sorts of information that is being made available to us, and we have to respond to it. And sometimes that information is very important, and sometimes it's not that important. So you have to think about signal, and you have to think about noise. And the way to do that is to think about what do you believe right now and how you should change that belief. And what you believe right now is part of the equation, which comes from what we call as base rates, which is historical statistical information. And it's very important for you to understand what is the meaning of base rates. Here we mean, let me explain this with the help of an example. Let's say we are going to be thinking about investing in a retail operation, in a retail business. And we have done some analysis of a certain company within the retail business, and we really like it, and we want to make an investment in that business. But here is the thing: a Bayesian would not think like that. A Bayesian would say, well, what are the prior odds? What is the base rates? How tough or how good is the retail business? He would look at what normally happens in the retail business. And if you do that, if you look at historical track record of the retail businesses around the world, you'll find that this is one of the few industries where the mortality rates are very, very high. I mean, airline industry is another one of them, but retail is another is a classic example of industries where the mortality rates are very high. So the average outcome is not good, and this is what a Bayesian does. He starts from base rates. He thinks about how tough this industry is, and then and only then he looks at information that is specific to the company that he's studying. He doesn't just zoom into the information that is specific to the company he's studying. He does not ignore base rates, and insensitivity to base rate is one of the big reasons why people make very dumb decisions in life, and especially in financial markets. And therefore thinking like a Bayesian and not ignoring base rates is very important. Let me explain again this with the help of a beautiful video lecture that was delivered by a lady called Julia Galef, and she explained this with the help of an example.
A while back, I made a video about Bayes' rule and explained how it had been influential in my thinking. I didn't really, however, explain how Bayes' rule works or what it is, so I'm going to do that today. I'll start with a puzzle. Imagine that you're walking across the campus of some large American university, and you meet a guy, let's call him Tom. You chat with Tom for a few minutes, and you notice that Tom is shy. He's not really making eye contact very often, he's mumbling. And my question for you is, if you had to guess, would you guess that Tom is more likely to be in a math PhD program or in the business school? Let's assume it has to be one or the other. So I don't know what you guessed, but I've taught a class on Bayes' rule a bunch of times, so I can tell you what most people guess, and that is that Tom is more likely to be a math PhD student. The reasoning is that shyness is just much more common in math PhDs than in business schools. And I think this is accurate based on my experience. There's an old joke that goes, how can you tell the extroverted mathematician? And the answer is, he's the one looking at your shoes instead of his shoes. Anyway, so I think that observation is accurate, but there's another piece of information that's relevant and that people tend to forget when answering this question, and that is, how many math PhDs are there relative to business school students? There's a lot fewer. The numbers will vary from school to school, but it's something on the order of 10 times as many business school students as math PhD students. So we have these two pieces of information about there being many more business students than math students, and also about shyness being more common among math students than business students. And the question is, how do we combine these two pieces to get one overall estimate about Tom? This is where Bayes' rule comes in. So you can imagine that this divided rectangle represents the relative proportions of math to business students, very roughly speaking. We'll put it at 1 to 10. And now looking just at math students, we can ask, how common is shyness? I would very roughly guess that it's about 75% of math PhD students come off as shy. And now looking just at business school students, again, guessing roughly, I'd say about 15% of business school students come off as shy. So now we've represented both of those pieces of information in one diagram, and we want to know whether Tom is more likely to be in a math program or a business program. We don't know which one he's in, but we do know that he's shy, which means that he must be in one of those lavender rectangles, right? Because those represent the shy math and the shy business students. So to get a sense of the relative probabilities of him being in math versus business, we just have to compare the relative sizes of those lavender rectangles. And it looks roughly like the lavender business rectangle is about twice as big as the lavender math rectangle. And you can see how the math shakes out. We just multiplied two linear ratios, the ratio of math to business students, which we put at 1 to 10, times the ratio of shyness in math versus shyness in business, which we put at 75 to 15. And multiplying those two linear ratios gives us a ratio of areas, which comes out to about 1 to 2. So roughly twice as likely for Tom to be in the business program, even though shyness is more common among math students. So this is the mechanics of Bayes' rule. This is how it works. And now I want to talk about how I use it in my everyday thinking. I don't plug numbers into a formula. I almost never draw these diagrams, in fact. But there are a few rules, principles of thinking that fall out of the math of Bayes' rule that are really useful for me. Principle number 1 is something like, remember your priors. So as you saw in the Tom example, what people naturally do is focus on the evidence that Tom is shy and forget about the prior, the sort of background knowledge that math is just a much less common major or program than business. And this is a very common phenomenon. It's called base rate neglect.
So base rate neglect is very powerful, and it's a very useful way of thinking about Bayesian probabilities. And people in the securities business, in the investment management industry, very often don't think in terms of base rate, and it costs them a lot of money. Another aspect of Bayesian thinking is something that I learned from Nate Silver, and he explains using the same methodology that Julia Gallup used, and the methodology that was explained by Danny Kahneman in his book Thinking Fast and Slow, as to how new information can sometimes lead you to very quickly change your prior views. And he takes the example of the two planes crashing into the World Trade Center on 9/11. And I'm not going to work through the examples, I just want to show you that imagine that you just got to know that the first plane has hit the World Trade Center tower, and you are thinking about the probability that it is a terrorist attack. And the way Nate Silver describes by using the Bayesian methodology is that when you put in the numbers, then there's a very small chance that it was a terrorist attack. And as you look at prior to the attack, the chance that there would be a plane hitting a building in New York City was very low. But once it has happened, the number shifts from 0.005% to 38%. It's still, that means there's a 62% chance, even after the first plane has attacked, that it is not a terrorist attack. It could have been an accident. But here is the thing, the Bayesian reasoning requires you to think along the following lines. Your posterior odds, your new belief, which has been created, which has been revised after new information has revised your prior belief, will become the prior belief for the next iteration. This is very important for you to understand. What this means is that you have a belief, you start with the belief which may come from base rates, and then you have new information, and that creates a new belief which is called a posterior belief. But the posterior belief in iteration 1 becomes a prior belief in iteration 2. So what happens? A few minutes later, the second plane hits the World Trade Center second tower, and in that setup, what you do is you take the 38% probability as your initial belief in the second iteration, and now respond to the new information that the second plane has hit the tower, and now you're trying to estimate what is the probability of these two attacks being terrorist attacks, and the probability jumps right from 38%, as you see on the screen, to 99.99%. This is a very powerful way to explain that how you should change your minds in light of evidence, which is extremely powerful. In this case, the first attack was not as powerful, but the second attack made it almost certain that the two attacks were terrorist attacks. And I like this example to not talk much about the mathematical ideas behind it, but directionally as to how to think like a Bayesian. And this is very important because in the securities business, in my profession, we have to respond to new information. Sometimes the new information, the weight of the new information is very powerful. For example, when Satyam Computers promoter Ramalinga Raju announced that he was committing fraud, it was very clear that whatever prior beliefs that you had about the company should change very quickly. And people who didn't make that change were holding stock were ended up having huge losses. So sometimes in the securities markets you have to change information very quickly. Sometimes the change is very gradual, and both the situations are adequately covered by using Bayesian thinking. So, what are the three key benefits? I think there are three main benefits of thinking like a Bayesian. The first is clearly belief updation. It is a formal process of helping you think about how to respond to new information as it comes in. And Nate Silver says that belief updating is to good forecasting as brushing and flossing are to good dental hygiene. It can be boring, occasionally uncomfortable, but it pays off in the long run. Essentially, it forces you to think about how you should change your mind. And people don't change their mind very easily. They keep looking for information that wants them to continue to believe that they were right after all. And this is a common bias, and a lot of research has gone into this bias, which is called as the confirmation bias, that people are very selective about what kind of information they will choose, and they will typically pick up the information or evidence that supports what they really want to believe, and they try to only intensify their current beliefs. They don't try to revise them dramatically, as might be required in a specific situation. Francis Bacon said that what a man believes he prefers to be true. And John Maynard Keynes was a Bayesian thinker, and he said that when facts change, I change my mind. What do you do, sir? Most people don't change their mind, and they rather play around with facts and numbers to continue to believe what they want to believe. All the great thinkers in the world that I follow are Bayesian thinkers. Here's another one, Jeff Bezos, and he says, people who write a lot of the time are the people who often change their minds. He doesn't think consistently of thought is a particular positive trait. Consistency of thought is a particularly positive trait. It's a perfectly healthy, encourage, and even to have an idea tomorrow that contradicted your idea of today. It's important to understand that the smartest people are constantly revising their understanding, reconsidering a problem that they thought they'd already solved. They're open to new points of view, new information, new ideas, and contradictions and challenges to their own way of thinking. This doesn't mean that they shouldn't have a well-formed point of view, but it means that they should consider their point of view as temporary. The second benefit is that it sort of forces you to think about baseline information, base rates, and this is what Julia Gallup mentioned in her beautiful talk. And I like to cite the example of this guy. He's a 99-year-old fellow who smokes 3 packs of cigarettes a day, and people look at this image and they start concluding that smoking is not all that harmful after all. But of course, this is exactly what insensitivity to base rate is. You're only seeing the guy who smokes and lived to the age of 99. You're not looking at the guys who didn't smoke, and there will be many, many more 99-year-olds in the group of people who don't smoke than the group of people who smoke. So you get hypnotized by the story that you see, and you don't think in statistically like a Bayesian. And I see that happen in the financial markets over and over again. People are interested in this stock and this company and not this class of stocks or this class of companies. Like I explained, you have an airline company and you really like it and you want to invest in it. You don't think about what normally happens to airline industries and what happens to the retail industry. These are two industries with very high mortality rates, and people who are insensitive to base rates, they tend to ignore them, and they tend to fall in love with the stories that they like, and then they get really hurt. One such story was the story of Theranos, and there's a wonderful documentary that has come out recently, and I want to show you the trailer of the documentary.
What do you dream for?
That less people have to say goodbye too soon to people they love.
I had heard about Theranos and Elizabeth Holmes, but her story's so compelling. She was going to herald a revolution in medical treatment in this country.
It was obviously such an incredible story. A woman creating this $9 billion company.
Everyone worshipped the ground she walked on. She could do no wrong. She was the next Steve Jobs.
The idea with the Edison was to stick the lab inside the box.
She wanted Edison devices in every home in America.
This could be the Apple of healthcare.
You all are part of something that is going to change our world. What higher purpose is there?
Elizabeth came to me, and she described her idea. It's impossible, physically.
Elizabeth was lying about the accuracy of the blood tests.
It's all a show.
She didn't want anybody to see what was going on in there.
We don't need to explain ourselves to competitive companies.
She aligned herself with very powerful men who succumbed to a certain charm.
She was deceiving investors to the tune of $400 million.
It comes back to fake it until you make it.
There was definitely something going on behind the scenes. She had bulletproof glass on their windows.
Anything I typed was watched.
It was very scary.
Like, what are they trying to hide?
The mantra in Silicon Valley is move fast, break things.
That's not the way you approach science that's going to be impacting people's lives.
Quite frankly, people can die.
It snowballed into this crazy situation.
In a panic, I went and bought a burner phone. I called the Wall Street Journal.
What is coming out of her mouth is not reality.
She never thought she had any limits. She was going to conquer the world.
This was real lunacy.
Can you tell us a secret?
I don't have many secrets.
One of the biggest paradigm shifts in my thinking, and also for a lot of people I know, has been learning about Bayes' rule. It's a simple mathematical formula that basically tells you how you should think about evidence. In other words, when you learn new information about the world, or you make some new observation about the world, and that could be anything, a fact you read in a book, or you wake up and you observe that it's sunny outside, or you call your friend and she doesn't call you back. Any new observation, how should that change what you believe is true about the world? And it's not like I go around plugging numbers into this formula all day. It's more like having my brain steeped in Bayes has just qualitatively changed the way that I think on a daily basis. So how has Bayes' rule changed the way I think? Well, first of all, it's made me a lot more aware that my beliefs are grayscale. They're not black and white. I have some level of confidence in all of my beliefs between 0 and 100%. I may not be consciously aware of it, but implicitly I have some sort of rough confidence level in my belief that my friend likes me, or that it will rain tomorrow, etc. And it's not 0% and it's not 100%, it's somewhere in between. And more importantly, I'm more aware that that level of confidence should fluctuate over time as I learn new things about the world, as I make new observations. And I think that the default approach that I used to have, and that most people have towards the world, is you have your beliefs, you're confident in them, and you pretty much stick to them until you're forced to change your beliefs if you see some evidence that absolutely can't be reconciled with them. But implicitly, the question you're asking yourself is, can I reconcile what I'm seeing or what I've learned or heard? Can I reconcile that with what I believe to be true about the world? So, for example, say I have a belief that I'm a good driver, and say also that one day I get into a car accident. The question that I would implicitly ask myself, naively, would be, can I reconcile this observation that I got into a car accident with my belief that I'm a good driver? Sure, I can. It was the other guy's fault. So I don't have to change my belief that I'm a good driver after seeing the evidence that I got into a car accident. But after sort of marinating in Bayes' rule for a while, you don't stop at the question, can I explain what I'm seeing while still keeping my beliefs the way they are? You go one step further and ask yourself the question, is what I'm seeing, is this evidence more consistent with my current beliefs, or is it more consistent with some other theory? In other words, is this evidence more likely under my theory, my belief, or is it more likely under another theory? So, getting into a car accident, sure, it is possible if you're a good driver, but it's a little bit less likely if you're a good driver than if you're not. So that doesn't mean that after I get into a car accident, I should conclude I'm definitely a bad driver. It just means I should be a little bit less confident that I'm a good driver if I've gotten into a car accident than if I haven't.
The story of Theranos is a very classic example of what happens when people get fascinated by a compelling story without thinking through the base rates. And here was a situation where some of the world's leading investors, institutional investors, gave her tens of millions of dollars, and they were basically being swindled by her. And nobody questioned her, nobody asked her the right question, nobody thought about how tough it was what she was trying to do, and how difficult it was, and how her charisma was playing a huge role in effectively seducing people to write large checks to her. So that's if you think in terms of baseline information, you start with the priors and then you look at specific information specific to the particular situation. You would have a much more grounded view of reality around you. The third benefit of thinking like a Bayesian is that it forces you to become more objective, because it forces you to look at evidence which sometimes is very contradictory to your prior beliefs. And if you think like a Bayesian, it will force you to recognize that evidence and force you to change your views about the world. And I think there's another way to explain this, and I would again use one of Julia Gallett's videos. She has a wonderful way of explaining things, and I really like the way she teaches, so I'm going to reproduce one of her talks to explain the point that I'm trying to make over here. This was very important for me to convey to you, and Julia did it much better than I could. And essentially, basically, she said that people have their pet theories, and they don't look at evidence objectively. And sometimes the evidence that they see is not consistent. It's much more consistent with an alternate theory. And by refusing to look at that theory, people are giving into confirmation bias, and they are displaying the rigidity of a mind, and they are not thinking like a Bayesian. And if you truly are like a Bayesian, you will come to learn that all your beliefs are grayscale, and evidence that is not present today might be present tomorrow, that will force you to think about your priors and will force you to change your mind in light of new information that completely changes the odds. And sometimes the new information that comes in is much more consistent with a different theory, not the one that you like, not your pet theory, not the narrative that you are fond of, not the narrative that you have based your investment on or your decisions on, but on something else. There's an alternate theory out there which is far more powerful and much more consistent with the evidence that you see, and therefore you should unlatch yourself, you should de-anchor yourself, you change your mind and get rid of your pet theory and discard it and reject it and move on to the other theory which is much more consistent with the evidence that you see. And that brings me to the last slide of this talk, or second last slide of this talk. And essentially I talked to you about the practical utility of 7 mathematical ideas. These are the ideas that you see on the screen. You studied them in school, and now I'm asking you to think about them again and use them on a routine basis to make you better thinkers in the world in which you're going to be living. I'll end now with a famous quote from Charlie Munger, which I think is very inspirational. And he said, worldly wisdom is mostly very, very simple. And what I'm urging on you is not that hard to do, if you have the will to plow through it and do it. And the rewards are awesome, absolutely awesome. We spoke of 7 academic ideas. All of them come from one discipline, mathematics. You have studied them in school. I'm now asking you to use them routinely in your daily work to become better thinkers in your life. Thank you.